Imagine waking up to a financial earthquake so profound it reshuffles the global order before your first cup of coffee. News alerts scream that a coalition of nations has made a unanimous, silent pact, not for war, but for financial secession. They have decided, en masse, to begin a strategic, irrevocable off-ramp from the world's reserve currency. This isn't about selling a few treasury bonds. This is a generational pivot away from the US dollar itself. And their vessel of choice isn't another fiat currency or a digital token. It is something ancient, elemental, and silent, tangible assets. At the forefront of this hypothetical shift sits not only gold, its traditional counterpart, but silver, the overlooked, industrially vital, and historically monetary metal. The immediate consequences would be more than a market correction. They would be a geopolitical Big Bang, unraveling 70 years of financial architecture and forcing a brutal reckoning with what we truly mean by value. While this scenario seems lifted from financial fiction, it is a stress test rooted in observable tensions, offering a terrifying and illuminating lens through which to view the fragility of our paper-based system and the silent war already underway for control of the physical world. To understand the cataclysm, we must first grasp the dollar's imperial yet invisible role. Since the Bretton Woods Agreement in 1944, and especially after the Nixon shock of 1971 severed the dollar's last link to gold, the US dollar has been the planet's de facto reserve currency. This exorbitant privilege allows America to finance deficits more easily, exert powerful financial sanctions, and export inflation. For other nations, it means holding trillions in dollar-denominated assets, U.S. Treasury bonds, as the bedrock of their sovereign wealth, trade settlements, and economic stability. This system creates a circular dependency. The world needs dollars for trade, so it buys treasuries, which finances U.S. spending, which puts more dollars into the global system. The entire edifice rests not on gold, but on a trinity of faith. Faith in U.S. political stability, faith in the credibility of its monetary policy, and faith that there will always be a deep liquid market for its debt. A coordinated move away from dollars by central banks wouldn't just be a sell-off, it would be a big wake-up call, showing that the whole system might not be as solid as we thought, and that the IOUs he's been writing are losing their value. The mechanics of such a shift would be a masterclass in financial stealth and strategic patience. Central banks would not announce a fire sale. Instead, they would engage in a multi-year, even multi-decade process of strategic diversification. Over time, they would allow maturing treasury bonds to roll off without reinvestment, or make small, steady sales into market liquidity, carefully avoiding a panic that would crater the value of their remaining holdings. The freed capital would not sit as cash. It would be deployed into a basket of tangible non-sovereign assets. Gold would be the primary recipient, a return to its historical role as the ultimate monetary cleanser of systemic risk. But silver would present a uniquely compelling dual-purpose proposition. For a central bank, acquiring silver would be a twofold strategic masterstroke. First, it is a monetary asset with a 5,000-year resume. It has been coinage for empires, a store of value through countless currency collapses, and maintains a strong historical correlation with gold during periods of monetary stress. Acquiring it signals a return to asset-backed sovereignty, a hedge against the very fiat devaluation they would be accelerating. Second, and far more powerfully in the 21st century context, silver is the ultimate strategic industrial commodity. It is the critical, non-substitutable input for the energy transition, solar panels, for advanced electronics, everything from EVs to defense systems, and for a digitizing world. By stockpiling silver, a central bank is not just saving money. It is securing the literal building blocks of future economic growth and technological sovereignty. It transforms their balance sheet from a collection of financial promises from a foreign government into a vaulted arsenal of industrial utility. In this scenario, silver ceases to be merely a commodity. It becomes a form of strategic energy and technology reserve, akin to a national oil stockpile, but for a post-carbon digital age. The move is both a retreat from financial risk and an aggressive advance towards resource security. The immediate global consequences would be a cascade of interconnected crises. The first and most direct symptom would be a violent, sustained surge in U.S. interest rates. If the world's largest pool of captive buyers, foreign central banks, steps back from the treasury market, the U.S. government would be forced to offer dramatically higher yields to attract other buyers, domestic funds, banks, retail. This would explode the cost of servicing the U.S. national debt, consuming an ever larger portion of the federal budget and forcing brutal austerity or reckless monetary financing by the Federal Reserve. The dollar's exchange value would plummet in a crisis of confidence, triggering imported inflation in America as the cost of everything from imported goods to commodities priced in dollars skyrockets. Simultaneously, global trade would seize up. The dollar is the lifeblood of commerce, the currency for over 80% of global trade transactions. If its value is gyrating wildly and its future role is in doubt, the machinery of cross-border business grinds to a halt, looking for a new lubricant that doesn't yet exist. The shockwaves would then hit the commodity markets with unprecedented force. The price discovery for assets like silver and gold would break entirely. The current market, where prices are set by a mix of industrial users, ETF flows, and speculative paper traders, is not designed for sovereign, price-insensitive buyers whose goal is acquisition, not profit. Central banks, operating with a multi-decade horizon and trillions in resources, would not be bidding on the COMEX. They would be making direct, off-market deals with national mints, major mining companies, and refiners, paying premiums to secure entire years of production. The price you see on a screen would become a ghost, a relic of a retail market that no longer has access to the physical metal. For industries, this would be an existential threat. A solar panel manufacturer would be outbid for silver paste by the Chinese or Saudi central bank. An automotive company could not secure the silver needed for its electric vehicle control units. The green energy transition, dependent on silver-heavy photovoltaics, would face a physical constraint no amount of money or willpower could immediately overcome. Geopolitically, the world would fracture into new blocks defined not by ideology, but by resource access and tangible asset holdings. Nations with large silver and gold reserves, or with dominant mining industries, Mexico, Peru, China, Russia, Poland, would gain immense strategic leverage. They could form a tangible asset block, trading resources among themselves on a new clearing system, potentially backed by a basket of metals. The U.S., stripped of its financial hegemony and facing internal economic turmoil, would see its diplomatic and military power severely curtailed as its ability to project financial force through sanctions evaporates. The weaponization of the dollar, a key tool in recent decades, would have triggered its own obsolescence. A new Cold War would emerge, fought not with missiles, but with vault inventories and supply chain controls over critical minerals. This thought experiment, while extreme, is not pulled from thin air. It is a logical extension of trends already in motion, accelerated to their conclusion. We are already in an era of dedollarization. Nations like China, Russia, India, and Brazil are actively establishing bilateral trade agreements in local currencies, creating alternative financial messaging systems to SWIFT and steadily increasing their official gold reserves. The 2022 freezing of Russia's dollar reserves was a watershed moment, a practical demonstration to every other nation that dollar assets are not neutral savings, but political instruments that can be seized. This acted as a wake-up call, accelerating the search for non-seizable apolitical forms of sovereign wealth. Furthermore, the sheer scale of U.S. debt monetization, the creation of trillions of new dollars, has sowed deep seeds of doubt about long-term dollar integrity. When the world's reserve currency printer operates with such abandon, other nations naturally seek lifeboats. Silver's specific role in this is crystallizing in real time. It is now on the official critical minerals lists of the United States, the European Union, Canada, and others. This is not an investment classification. It is a national security designation. The U.S. Defense Logistics Agency has been authorized to stockpile silver for national defense needs. China has been a net importer of silver for years, despite having significant domestic mining, suggesting state-level accumulation. These are not the actions of investors speculating on a price. They are the moves of states preparing for a future of resource competition. Central banks diversifying into silver would simply be following this strategic logic to its ultimate conclusion on the asset side of their balance sheets. Therefore, the question, what if central banks dumped dollars for tangible assets like silver, is more than a doomsday fantasy. It is a framework for understanding the profound vulnerabilities in the current system and the strategic calculations of nation-states. It highlights that true power is ultimately migrating from the digital ledger of debt to the physical reality of constrained resources. The scenario would be less a sudden explosion and more a glacial, deliberate retreat from a shared fiction, the fiction that unbacked currency is the pinnacle of value, and a return to an older truth that human civilization, especially in a technological age, is built on and powered by tangible things. Silver, straddling the worlds of ancient money and modern necessity, would be at the heart of this transformation. The central banks may not be dumping dollars for silver tomorrow, but by asking the question, we see they are already, quietly, preparing for a world where that might be the only logical move left. The writing is not on the wall. It is in the geological surveys, the critical minerals reports, and the steadily rising gold and silver reserves in the vaults of the East. They are building a lifeboat of atoms in a sea of digits. The only remaining question is how many will have a seat when the final whistle blows.